Welcome to another accounting video, and today a requested topic which is inventory valuation. I've already done a specific paper on inventory valuation, but this is going to be a revision video, so just around the area of inventory valuation. So this is an ACCM-free topic, so an A-level topic. So I think the most important thing about inventory valuation is the golden rule of it, which is essentially it's valued at the lower of cost, so the amount it costs the company to buy in these goods, and the net realizable value, so the selling price minus any repairs required to get the goods up to sellable condition. So the lower then is what is the value we will use to value our goods in the closing inventory. Why is this? This is due to International Accounting Standard number 2, so the one that's concerned about inventory. This is what it says in that standard. And prudence, the accounting concept. So we're going to lower profits, increase expenses in a sense. We're going to get a prudent view of the accounting period is what we want. So I thought I'd quickly go through an example. This has got nothing to do with AVCO or FIFO, which we'll get onto later. This is about general inventory valuation and how this rule applies in practice. So the only bits I'm concerned about are the areas in pink rings, which is about inventory. So I've just been told to calculate the amount of the inventory that I should put in the account. So this is to calculate the new closing inventory figure. That's all I really need to do. So closing inventory was shown at cost price of 83,500. The closing inventory includes 500 units that are in need of repair. So obviously we already know it's cost versus net realizable value. It's going to be one of them questions. So first thing I can do is try and work out what the net realizable value should be. So the NRV. And I already know that that's selling price minus any repairs. So firstly what I'm going to do is try and work out what that is per unit and then times it by the amount of units I have, so I have the full figure for this 500 units batch in a sense. So the repair cost to convert the inventory into saleable condition was 30% of the original cost price, and the goods are marked up 20%. So how am I going to work this out? So essentially it's going to just be $24.99, so the cost price, times by the markup 20%. I'm going to take away the amount it's going to cost to repair these goods, so 30%. And that comes out at 22,491. I'm just going to keep it as a decimal for now, and then we'll make it into a real monetary figure later on. So the total for this, in terms of all the units, is 22,491 times by 500 units, and that gives me 11,245.50. So that's my net realizable value figure. Easy enough. The cost figure, well, that's really easy. It's just the cost we had to buy it at, $24.99, times by 500 units. So what's that? That's just 12,495. So now what I need to do is compare this cost figure with this net realizable value figure. And you notice that this one's obviously smaller. So what I'm just going to do is find out what the difference is. So take the cost figure minus the net realizable value figure, and that gives me 1249.5. That's gone down. So how am I going to work out this new inventory figure? So this new closing inventory figure. Well, I already know that the closing inventory was shown at cost price, and we've just proven that this 500 units should be valued at net realizable value. It's lower. We're following IAS 2 here, aren't we? The lower of cost or net realizable value. So we need to bring this inventory figure here, 83,500, down by this difference. So 83,500 minus 1249.50 gives me a final figure of 822.50 and 50 pence. So essentially what I've done it there, round it all off, I've calculated the cost value of this 500 units, the net realisable value of the 500 units, found out that net realised value is lower. We're going to use that figure now because of IAS2 and prudence. We're going to find out what the difference between them two was and then just change our inventory figure as we should. And it's as simple as that. 82,250.50 is the closing inventory figure that we should use in the accounts. So that's that example done. So the only other AVCO or FIFO question I could find is what I've done in a previous paper. It's an ACM free paper if you can dig it out in the playlist. So what I thought I'd do is just write out my own example in a sense. So Fisher PLC calculate the FIFO and AVCO closing inventories essentially. So we have an opening inventory, we've bought some goods, we've sold some goods, bought some more goods, sold some more goods. Simple as that. So this is going to be the FIFO example. So how I laid out, it's all different teachers across the UK, all different mark schemes. It's all different. People laid out differently, but it's the same idea and the same concept behind it. It's just how you laid out that can be different. So this is how I laid out. I wasn't taught it this way. I just do it this way because I find it a bit easier. So along my left hand side here, I have all my purchase dates. So I opened up with 500 units. So opening inventory 500 units. I don't care about any purchase figure, cost prices right now, not yet. And purchases, bought 600 units on the 5th, and on the 15th I bought another 600 units. And then these are my sale dates, these two here. Sold goods on the 9th and sold goods on the 19th. So purchases, sales, simple as that. So on the 9th I sold 700 goods to Karpov Limited. So the idea of FIFO is first in, first out. Hopefully you all know this and this is actually revision for you. So I've sold 700 goods. So the 700 needs to come out of the first goods that came into my company. So the first in, first out. So we brought these goods in first. They're going to be the first to go out when we make a sale. So think of it as use by dates in a supermarket. If you've got some bread that you've bought in and it goes out of date on the 14th, for example, and there's more bread that goes out on the 20th, you're going to sell the bread that goes out on the 14th, goes off on the 14th, aren't you? You're not going to sell the 20th of, say, November stuff. You're going to sell the later date and then leave the 14th to sort of go out of date, and then it won't be sellable. So simply, we brought this good in first. We're gonna take it out first when we sell it. So we sold 700 units. So that completely wipes out the first purchase, and then 200 taken out of the 5th. So we can just say that's 700. So see, my 9th, 500 plus 200, 700 to Karpov Limited. Simple as that. So I've still got 400 units left there. None was taken out of this 15th purchase. And actually it hadn't happened yet in a sense as well. So we sold some more goods to Alekine PLC of 800 units. I don't care about the unit figure. I don't care about any of that yet. So I can't take anything from that because I haven't got any units left on the first, have I? I can take out the full 400 to eradicate all these, and I can take out the final 400 from the final purchase on the 15th. So they're the two sales done, the 700 on the 9th and the 800 on the 19th done. So I've got no units here, no units here, 600 minus 400, 200 units here. So I have 200 units left. How am I going to value them? Well, how much did I purchase them for? I purchased 600 units for £12 a unit. So that's simply £2,400. And that's it. That's my closing inventory figure for FIFO, first in, first out. So it's as simple as that. You probably learnt different methods in your times of learning this, but this is how I laid out. But yes, so now to do it with AVCO. I'm going to use the same information. So essentially what is AVCO? Every time you purchase you're going to make an average. So we're going to bring in goods, doesn't matter what purchase price they are, because we're going to average it, so all the goods have the exact same purchase price in our accounts. How do we work out that average? It's just the total value over the amount of units. It's quite simple, isn't it, in a sense? So the purchase on, we don't need to average the first, do we? Because we already know what the average is, it's £10. But the purchase on the 5th may change that a little bit, so let's just average it anyway. So the total value, how am I going to work that out? I'm just going to do 500 units times by £10 a unit, so that's the first, the opening inventory, plus the value of the purchase, 6,000. So it's been presented in two different ways, then parts. That was given in per unit, and that was given as a total. So how many units do we have? Well, it's simple, it's just 500 from the opening inventory plus 600 from the purchase. And that gives me £10 a unit. And just put in brackets, there's 1,100 units there. It's just good to remind yourself. So the sale on the 9th now, this affects it obviously. It's going to bring down not only the amount of units we have, but it's also going to decrease the value of these units. So we had 1,100 units and we sold 700. So what we could do is actually work out the change in value first. So the new value figure is, well, we had 1,100 units, then we lost 700 units. And we're going to multiply that by the value of each unit. So it's just 400 units times by 10, so that's just £4,000. We need this later on because we're going to have to average again, aren't we, when we make a new purchase. So we're going to need a new, we're going to need to make sure we remember this. So the amount of units after this sale is just 1,100 minus 700. So it's just 400. Easy enough. So after that sale, we're left with a value of £4,000, 400 units. So still £10 each on average. So we purchased some more goods on the 15th. We bought 600 units for £12 a unit. So what you should notice is I don't care about the selling price. I've not mentioned £16 or £18 anyway. It doesn't matter the selling price, does it, in our inventory valuation, is it? It's meant to be a cost. So with that in mind, let's continue. So I've got the 4,000 from the previous calculation plus 600 units at £12. Sorry, 600, not 6,000 at £12. So I can take this 400 units plus the 600 units from the new purchase, and the new value is 1120 a unit. And I've got 400 plus 600 units, so that's 1,000 units. As easy as that. So let's see if we can just get that on the screen. Okay, so we just sold some goods, didn't we? So how are we going to calculate this? Well, we don't need to calculate the units anymore. This is the final sale of the month, isn't it? I'm only doing it for May. So the final sale of the month, all I want to do after this is just calculate the closing inventory. So I just need a valuation, don't I? So I had 1,000 units. Sold 800 to Alakine. And they're worth £11.20 a unit. So my closing inventory figure is 2,240. 200 units, just like FIFO. So we've both been left with 200 units. That's obvious. You have your goods bought in, you have your goods sold. Units in, units out. It should be the same. However, if you notice, the valuations are different. FIFO gives it at 2,400. Yeah, AVCO gives it at 2,240. So why is this? Because the number of units is the same. Well, it's essentially, what's happened here is we're only using this £12 here, and that only comes from the purchase on the 15th. We've not used the purchase prices here, have we? Whereas AVCO has. It's used an average, 11.20. So the £12 just comes from one purchase. The 11.20 comes from 3 rounds of purchases and open inventory. So that's how they differ in a sense. They're not always going to give the exact same answer. So, quickly round it off, FIFO and AVCO, advantages and disadvantages. You can also find this in the textbook, that's where I've essentially copied it from. So, FIFO, I find it really easy to calculate using that table. It uses actual purchase prices in the closing inventory valuation. So if you see here, we've got the units here and an average price. That never existed. We've never bought goods at 11.20. Whereas this figure here, the 12 units times by the figure, we actually bought goods at £12, so it's using an actual figure. It's also logical. Goods are sold in order of purchase dates. Like I said before with the use by dates, you bring in goods and you sell them goods first, in a sense. Advantages of AVCO. So cost of sales and profit are smoothened. This ties in with the fluctuations of purchase prices are smoothened. So if you see here, we've got changing purchase prices. We've got £10 here and we've got £12 here. So it's worked out an average of 11.20. It's also taken into account the fifth. So it actually smoothens out these we might have a high purchase price and a low purchase price next week. So it finds an average, and therefore not only is your closing inventory more consistent and more smoothened, also your cost of sales and then your profits are. So it's a bit easier to predict in a sense, your closing inventory valuation. And also, what's quite smart about AVCO is it assumes identical units purchased at different times are valued the same. So here, we're purchasing identical units, 500, 600, 600, but they're all valued differently, whereas here, AVCO, it averages all the units, regardless of when they're purchased. So, FIFO disadvantages. In times of rising prices, it gives a higher profit. So if you look, what I've done here is, on the first £10 a unit, then on the 5th it's also £10 a unit, but then it goes on the 15th to £12 a unit. So it's rose, the prices rose for us, and it gives us a higher closing inventory figure, 2,400 compared to 2,240. So this higher closing inventory figure will decrease our cost of sales, won't it? It's taken away. So if it decreases our cost of sales, it'll increase the profit, won't it? So rising prices gives a higher profit, which means more tax, essentially. So bigger income coming out of the company. And also the cost of sales may not represent current purchase prices. If we're using inventory, say from the 1st, in our closing inventory valuation at the end of the month, it's not representative, is it? It's using inventory figures from ages away, which may not representative of today. So that's FIFO. AVCO, it's not an actual purchase price. So 11.20, we never purchased goods for 11.20. We purchased them for £10 and £12, didn't we? So something to bear in mind. It's more theoretical in a sense. And every purchase requires a new average. So when we purchase goods on the 5th, I had to do an average. When I purchase goods on the 15th, I had to average again. So every time I buy goods in, I have to work out an average. So that's inventory valuation. Quite a quick video. Hopefully you all understood what the main ideas are around inventory valuation before this video. But anyway, if you've got any requests, always email me. The email's always in the information below the video. But besides that, thanks for watching and see you in the next video.